Looks like we should start. Just gonna switch the watch. Huh? Going for white. Going for white. I'm wearing black, but I got white pants, you know? All right, who's ready to go? Well, if I can find the music, I guess that's a good time to rotate in. Yeah. So, guten Morgen, como allez-vous? How are you doing today? Today's an interesting day, huh? Yeah, it should be interesting. A lot of news. A lot of news today. Lots going on. Most important will be later today. That's all right. Cool. So I popped a poll and it says, hey man, what do you stink? Smells like risk on, smells like risk off, smells like risk neutral, and oh no. What are your thoughts today? What's going on in the world of trading and investing? Hang on, I'm trying to refresh a browser over on the other screen. It's not cooperating. So please do the poll and we'll figure out what's what. Meanwhile, I posted a link earlier, like when I launched, and it has a link to today's Fed meeting. Would you like to gather today as a community? Hang on, I'm just going to open a whole new browser. The other browser's not playing nice with me. So go ahead and fill that out, and I'll zip over to the screen later, shortly, in a bit. And then we'll dive into it. Hang on. I'll be there for you. These 5 words I swear to you. When you breathe, I want to be the air for you. I'll be there for you. I mean it, I'd die for you. Steal the sun from the sky for you. Words can't say what love can do. I'll be there for you. All right, cool. Oh, your customer wants to talk about gold? Yes, we can definitely do that. So I will mark this as the beginning of the webinar. Welcome to Forex.Today, the YouTube community of more than 20,000, in fact, almost 21,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance, because trading is risky and not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Hello, my name is Wayne. Maybe later today we could do some TRADARS. Could be a rabbit, could be. Yep. We'll even use QuantBox today. Well, when you use these tools, I suggest you use an ECN. And the ECN that I recommend, there's not many ECNs. It's a unique business model that doesn't screw over their clients. By the way, check that out, huh? Yeah, neat, huh? So if you have a business model that doesn't screw over your clients, then you got to do the opposite. You got to serve and provide value. You have to, right? Because there's a symbiotic relationship. An ECN serves itself best by serving you above and beyond all other competitors. Straight through processing. They don't monkey around with spreads. They don't monkey around with hoping that you lose. See, like, for example, if you go out and you choose the cheapest broker you can find, the one that promises you like 0.5% spread on euro dollar, and you're like, oh, that's so cheap. Well, be careful. They're probably slipping every time you trade. There's a half a pip spread, but then they slip you another half a pip or a full pip. It doesn't look like much to you. You may not even notice it. But then they do it on when you exit a trade. Again, that's called slippage. So you say, get out at this price, and they get you out a half a pip. You don't even notice. Maybe 1 pip different, and you don't really care. But here's the thing. Those types of brokers promise you a half, and you end up paying 2 or 3. And you don't even notice, and they're like laughing. And you think, well, Wayne, I don't know. Do they really do that? There was a major broker in the United States several years ago, and the NFA forced them to tell all their clients that not only was there slippage, but there was an algorithm on their server that did it automatically. So they promised one thing and did another, and the NFA thought that this was not in the best interest of the clients. And so that broker then sent out a new thing, and not only will they slip for you or against you, but sometimes they'll slip for you. And like what? It was the weirdest email ever. But here's the thing. Some brokers out there have it built in. So they promise you a half a pip and you end up paying 2 or 3. And they laugh because you don't even notice. That kind of stuff is just normal. An ECN just doesn't do that. They just don't. That's not how that model works. So I recommend Trader's Way. That's my ECN. So anyways, Trader's Way, you should check them out. It's important because, we're talking about your business, man, right? I'm not a businessman. I'm a businessman. So anyways, be careful on who you work with. Okay, today we have a lot of news on the calendar, and we've had ADP, $1.92. Okay, not far off of what has been trend. Okay, Not far off of what has been trend. Okay, so let me pull up the link to today's special event.
Hi, Currency Trader. My name is Wayne McDonald.
That's me.
I've been trading Forex since 2004. If you subscribe
Actually,
to this channel...
that's not actually true. I've been trading publicly since 2004. I've been trading longer than that. All right. The live Fed meeting and press conference, will they cut soon? So you can register and we can trade that together. Oh, let me do that.
To the community, Forex.Today.
There is the link. There's notify me in 4 hours, huh? Oh, Jim's already there. Hey, Jim. That's pretty funny. Okay. Yeah. So, yeah, there you go. I will see you then. Later today, we have some PMI. Manufacturing side. Remember, there's the headline PMI and then there's output, right? So anyways, some contraction, but basically flat. Okay. The UK has horrible numbers and Europe has even worse than horrible numbers. The United States is kind of flat, but we're not really a manufacturing economy relative to our services. I know this because at Investor Boot Camp, I went through UK, Euro, and US PMI numbers, and we read all the reports. We actually read the reports. Is it a nerd fest? Yes. Okay. Nerd fest, nerd alert. Okay. Nerds! Yeah, but look, if you're going to be nerdy, be smart. And if you're a smart nerd, you're rich. I like the word nerd, actually. I'm not too nerdy. I'm a little bit nerdy. My kids actually said, Dad, you're actually a nerd. I'm like, really? I have very, very nerdy friends. Very, very smart, talented guys. When we were young, I mean 20, 21, we were just a band of brothers. And with very little, like I ran a small little business in college and worked in the nonprofit world and had crappy cars, and my friends had crappy cars. I mean, things like windows wouldn't roll up or down and all that kind of stuff. Really, modest. We were modest kids, big dreamers, hard workers, and they were well beyond my intelligence level, much smarter than me. So very, very nerdy. And I say that in a positive way. They're all about 50. Okay? Almost 50 in most cases, but not quite. But they're about 50. They're all fully retired multi-millionaires. Yeah. Yeah. One of my buddies flies airplanes and helicopters. And I think he's 47. Doesn't work. Good for them, right? So I love nerds and being nerdy. And so actually reading the economic report, nerd alert, might actually make you smart. Or at least 1% smarter than everyone in the Forex world that you're competing with. And you might have the edge on your trades by being on better trades, more informed trades, better informed decisions. And, I think you should be nerdy by actually doing the work. Because I can tell you, those that are more focused on getting rich quick, they might be dreamers, but reality and their dream will not likely align. Okay? Yeah. So that's what we did. And so in my mind, I can tell you UK and European PMI and compare it to the United States PMI. We just know these things. So if you like that kind of stuff, we do that at an investor boot camp in the swing trading group. It's only $99 a month. And that's not all we do. That's just one of the things we do every week. Cool. So we got some more PMI stuff coming out. We have some JOLTS coming out, and I studied JOLTS at Harvard, which is interesting. So I do know at least the Boston Fed looks at JOLTS. It points to a bigger problem, but they actually use it in their modeling. And so I was taught. My professor's name was Green, and he was at that time a senior economist at the Fed, and he's still there. Cool. And then all of that gets overshadowed today by the interest rate decision. So we will watch that together. And we can use TRADARS to look at patterns in the past. I'm worried that there's more likely to be chop than anything, but that's the reality. Okay. Moving out to Friday is non-farm payrolls, and that'll be at FX Street. So we have a nice week. Today should be interesting while we move up to the Fed funds rate. I'm worried, like I said, that we get more volume than normal, and I don't mean than a normal day, but pre Fed decision day, you usually lose volume and volatility. Well, I'm worried that we get volatility and no volume, or we get volume and volatility, but not in any particular direction. And so, we might get some stormy chop today. So let's see how you guys feel. Thank you for participating in the poll. I appreciate it. Let's see what you guys think. Risk off, okay, because yesterday was a big down day. Risk neutral. Risk on, very few are risk on. So those guys are buying dips. And no clue. Thank you. Thank you for the honesty. Now it's anonymous, so no one's going to laugh at you. One way to answer that, by the way, no clue people, in general, how do you know, okay, risk on or risk off? You can just go to the risk gauge. And when you look at monthly basis, that's rolling 30 days. Okay, rolling 30 days. The S&P 500 is down almost 3.5%. That's bad. Risk off. Yields are up a lot in the treasury market. That's also bad. Yen futures are down. Okay. Month over month over the last 30 days. Yen is still weaker than it was 30 days ago. Well, that's actually good. That's typically a risk-on scenario. It doesn't match what's going on around the world, but you should still know. And that shows the central bank's intervention. So anyways, month over month, yen is weak, and that's good. Dollar, however, is strong. Well, that shows risk off. Gold is up. I consider that bad, and that's why I score it negative. Okay? So that's also risk off. And volatility, VIX. Now, it's not always volatility. What it really is, it shows volatility and risk perception. But what they're actually doing is this is institutional investors that are exposed to the S&P 500. So they own billions and billions and billions of dollars of stock. They don't plan on selling the stock because they bought it at the COVID dip or even before. They might be in some of these positions for a decade. So they see the perceived risk of, at least in the short term, but maybe in the longer term, that asset class will fall. The S&P 500 it will fall. And of course, it is falling by a significant amount. It was down 6%, still down 4%. That is bad. So this is institutional investors using the options market to hedge their exposure to the S&P 500. They're hedging their stock positions. This is not an opinion. This is institutions actually buying options to protect them from the downside risk. It's real, it's happening, it's real money. And we measure this every day, every week, and every month. And so if they're buying insurance to protect them from downside risk, well, they perceive that the market is risk off. So for those that have no clue, I can say, well, on the long run, the trend is down. The risk is off. And and remember, again, not opinion. Okay, they are buying gold. They are buying dollar. Yields are going up. So that means the treasury market is falling. That's bad. The stock market is down, not an opinion, not a survey. That's not how people feel per se. It's how they're behaving. So for those that don't have a clue, well, check it out. Quantitatively speaking, analyzing 6 different asset classes, which you could say is us surveying the behavior of 6 different types of traders. The congruency is risk off. So now you could be risk off. Yesterday, and if you watched yesterday's video on QuantBox, let me give that to you now. YouTube.com/@QuantBox. This was so important that what I'm about to share with you. Yesterday at 6:30 in the morning, we had a risk-off scenario, and weekly and daily was risk on. So we were short-term long, but long-term short by analyzing these 6 different traders, okay? Traders in 6 different markets. And on the short run, they were long, but on the long run, they were short. What I suggested pre-market open, 6:30 in the morning, is that created a high probability of these turning risk off, meaning the stock market was very likely to fall, even though everything was up short term. And this was such an important point that I actually shared this instantly after I was done with the QuantBox Live. Usually what I do is I upload it to YouTube, or often I forget and I don't even upload it. Hey, it's free. Okay? But I thought yesterday was so important in the process of doing technical and fundamental analysis that I released it instantly. So therefore, by 7:30 in the morning, everybody had this. Everybody in the world that subscribed to QuantBox, they had it for free. So that's 2 hours before the stock market opened. And then the stock market opened and the stock market collapsed. You're welcome. Look at it. We're going through it and going through it and going through it and going through it, right? It shows the process of decision making. And we hit it hard, risk off. And let's see if we can even find the risk gauge. Oops. Where was the risk gauge? See? Risk on, risk off. Get ready for the sell, because the other side of it is technically we knew that for over the week there were several days, 2 or 3 days in a row of up. Collapse. Sell high. Sell high, sell high. And then, of course, now you know yesterday was a massive down day. S&P 500 down 1.6%. Look, it was risk on that day. And then it collapsed. There you go. So if you haven't done it, seriously consider subscribing to QuantBox YouTube channel. It's free, bruh. Okay? Andrew's like, gotta love QuantBox. I love QuantBox. Okay? Holy smokes. Okay, so now it's mixed so far, but the markets haven't really opened. And we had a swing back around recently as we wait for the Fed meeting, but it just shows you like we're going neutral again while we wait for the Fed. Okay? And we look at things like heat maps. It's good to know these things. And then we organize our thoughts with long-term fundamentals. Bullish, 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 bullish. Okay? Very bearish, bearish. Okay? And then everything else, be careful. And then you take that and then you end up doing what? Well, you can go to your charts and you can simply do technical analysis. And you can say, fundamentally, gold is neutral right now. Technically, it's bearish. How easy is that? Yeah. Cool. Okay. And then you can run through all your assets. And this is before you even look at a chart. Silver, much the same. Oil. Okay. All these things are changing. Dow. Whoa, 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 huh? We've added Russell. Right? Those are small stocks. Of course, we have all the other stock indices. Huh? You like Dr. Copper? Look at that. We added copper. Okay? What do you buy when there's persistent inflation? Real assets like metals. Well, this is an industrial metal. The precious metals have come down, but not the industrials. Okay, so anyways, really beautiful, powerful stuff. What's going to happen when central banks start reporting, okay, we update with their forecasts. So when the central banks update us, okay, we're immediately updated because we pull all this data from the central banks themselves. That's super cool, right? So for example, you can look at the Bank of Japan. They have told us this is where they believe interest rates will be in the future and where inflation will be in the future. And then we can, right, we can graph it. Okay? So I'm giving away a lot of value here because most people don't really know this. And you hear experts on TV all the time. They think this and they think that. And they think maybe the Bank of Japan will raise interest rates, but maybe not. And they have debates. The talking heads debate. Do you know what this is? This is what the Central Bank of Japan has already told us. I don't have an opinion. I know. Do I know what the future interest rate will be in Japan? No. However, I do know what they have told us. And then you can compare. So we're in the second quarter. Okay. And, you can now pull up CPI for Japan and see, is there inflation forecast that they gave us in the past? And I keep updating, or it keeps updating as they update us. But how are they doing relative to how they expected? And will that change the policy? Okay. If it's too low or too high, it could change the shape of this curve. But right now, as of right this minute, that is perfectly accurate. And then you can compare all the different central banks around the world and to, again, maybe create a fundamental bias. Nice. Isn't that nice? Oh my God, it's amazing. Okay. It's amazing. So we got a news coming up today. Okay. And like I said, my worry is it creates choppiness, but no real direction. And then we sit around and wait for the Fed. And even then, creates volatility, but no volume in any particular direction. Now, your customer says no clue. Okay. Everything depends on the rhetoric of the press conference. Yes. Hawkish or not. Yes. If he says no cuts, then the dollar will get strong. Maybe. Remember, we've already priced in a lot of that, but yeah, probably. If 2 cuts, the dollar get weak. Not necessarily, because once again, we already priced that in. Okay, remember, when it comes out, it doesn't create the move. So let's go here. Okay, so let's go here. So my point is, from April to now, the dollar's already strong, your customer. And it's because, well, we've already anticipated that the Fed might only cut twice instead of 3. Now, back in the earlier Fed meetings, they told us 3. But since then, we've had persistently high CPI. And PCE is stable but not falling. Okay, so we've already priced that in. And when I mean priced in, a lot of people used to just say that, which really meant they didn't know. Okay? But there's a way to measure this now. Okay. And so we can look at it. For example, let's go to between now and the December meeting. So there's the May meeting, June, July, September, November, December. So June cut, September cut, December cut. That's what I said in January. Even though the market said 6 cuts, I said, well, 3. And I used the timing of the election to try to guess on this. And also my experience of when the Fed typically cuts interest rates and which ones, like which meetings and which meetings they don't. And then also the psyche of the Fed is to appear non-political. So if they're going to do 3, they can't do 3 like September, November, December, because it's too close to the election and too fast. So to deal with the political risk, what I suggested in January was that they create a schedule. And I compared it to like being the CEO of a multinational corporation who owns a lot of stock because they get compensated with stock options. Well, the CEO can actually be arrested for insider trading if they sell a whole bunch of stock and then later that month report that things are bad. That's called insider trading. So to deal with that, what they do is schedule it. And they say, well, every quarter or twice a year or once a year on a regular schedule, they'll sell the same amount of shares so that they appear indifferent. So if the company is doing well, they sell 1% a year. And if the company is doing bad, they sell 1% a year. So in this case, I'm like, well, that's what the Fed is going to do. And so therefore, if they are going to do 3, it would be starting in June, and then it would be every SEP, every other meeting. So May, pause, June, cut, July, pause, September, cut, November, pause, that's the election, December, cut. 1, 2, 3, every other meeting scheduled in advance. Very predictable, very reliable. So now we can see, well, okay, we're at, where does it show it? We're at 5 1/4, and we're likely to stay at 5 1/4. Okay? Not only 1% chance of a change, and then that 1% is a raise, not a cut. All right, so we're at 5.25. By the time we get to December, what is being priced in? You see what I'm teaching you? What does it mean to price things in? So 5.25 is here. So what's being priced in? 1 cut, 2 cut, 3 cut, 4 cut. Okay, so we're 5.25. 1 cut, 2 cut is by far the majority. So logic dictates what is priced in is 2, not 3. Okay. Now, what about this 4.5? That's the 3 cut. A month ago, okay, 4.5 was at 33%. Now it's at 8. What does that do? Dollar strong. Okay, your customer? So it's like, well, if it's only 2 cuts, okay, but we've already done everything. You see, it's already done. People have already analyzed this. They've already made their decision. It's already in play. This is institutional money, in particular banking money, negotiated between banks, banker to banker. And it's real money, not a survey, not an opinion. This is real money, real negotiations. So for assets, okay, for December 18th assets, the price was 94.91175. Okay, so 95. What does that mean? What does that mean? I'll lend you $95 today. Okay? And you will pay me back $100. And if you do the math, the reverse engineering, you can figure out the implied interest rate. And that's how this works. And that is being done to the tune of hundreds of billions of dollars. Not an opinion, hundreds of billions of dollars. And this is the average price negotiated. Now, there's multiple prices depending on opinions. But remember, these are negotiations. So JP Morgan is negotiating with Wells Fargo, for example. I'm just making something up. I don't know if they are. But this is a normal thing between banks, so there's nothing wrong with it. So, okay. So JP Morgan says to Wells Fargo, okay, we'll lend you the money. Okay, we'll lend you at right, and then you negotiate the price. And then JP Morgan says, well, we think Fed funds rate will be here. And Wells Fargo says, we think it's going to be here and whatever. And you get to a point and you negotiate and you get a price. Okay? So at the June meeting, right now, there's only a 10% chance of a cut. That used to be, okay, June being at 5. A month ago, where's 5? It was almost 60%. Now it's less than 10. Okay? That's cuts coming out of the market, dollar strong. Well, that's why the dollar's strong, bro. That's why I'm showing you this. This is what's going on. Dollar's strong because of this. We call this the Johnny trade. Yeah. Because when I taught Johnny this, he's like, I'm going to watch this every day. Sweet. So that shift dictates dollar strength based on their opinions for the future. By the time we get to SEP, it's 50-50. If this is changing, okay, if this goes to 60 and this drops to 30, that's more dollar strength. How many people love this quantitative analysis of money flow? We're tracking the money flow in the Fed funds futures market and in the VIX market and in gold and in treasuries and in dollar and in yen and in the stock market. Like, holy schnicker-schnocker. And I'd like to add the put-call ratio as well to get even smarter. I know a male model like me probably can't get smarter, but I'm going to try. Okay? Yeah, I'm going to try. Okay? Like Texas women and their hair. If it can be done, it will be done. Sorry, ladies. Yeah. Cool. So, that is not Nerd Fest, right? Nerd Fest. So anyways, if we look at this, drop this into an hourly chart, and kind of zoom back a little bit. Okay. Can you see this? I haven't touched it. Okay, you see this? Plan A, sell 5,100. We created this on Thursday at investorbootcamp.com. Okay. This is what we do on Thursdays. Remember I said on Tuesday we downloaded and actually read the economic reports from around the world. And I mean the UK, Europe, Australia, the United States, usually, Japan. Usually if there's Kiwi news, we read it. We do that on Thursdays. Tuesdays, which is fundamentally, right? I teach you how to do things fundamentally. On Thursday, it's technicals in the swing trading group. And so imagine this. On Thursday, we are down here. And we say, yeah, well, it's going to go up and then we're going to sell here. So we had to analyze and plan the up before the down. Oh my gourd. Okay. Oh my gourd. And we had a plan B just in case, which means if it went even higher, we're still a bear. Now, how do we get that kind of bias? Quant box. Andrew says, how do you use the VIX? Are there certain levels? In the QB, all we're looking at, okay, is over the time period, which is daily, weekly, and monthly. So we look at 3 time frames. And is the activity increasing or decreasing? So we're not using price, we're using flow. Okay? Is money going in? Is money, because it's not the VIX per se. An increase in the VIX shows an increase in the purchase of options on the S&P 500. Okay? So an increase is risk off. So we look at it day over day, week over week, month over month. A decrease means people don't need insurance on their stock positions. Why? They don't think it's going to go down. You wouldn't buy insurance if you thought it was going to go up. And you're like, well, I'm not worried about this going down. So why would you waste the money? Buying insurance is expensive. So that's what we're tracking, is their thought process. Okay, but it's not a price level. It's not like, well, above 18 we're bearish and below 18 we're bullish. No, it's not like that. Okay, but it's a great question. Okay, we're tracking the flow, not the stock. So like there's another example, flow versus stock. So QuantBox uses the COT report because it shows us institutional positioning. And so we make a distinction. This is the capital stock of all institutional investors in the United States. Okay? How long are they for the Japanese stock market? How long are they in copper? How long are they S&P 500 versus NASDAQ? And then it goes neutral, neutral, neutral. So they went from very bullish on Bitcoin to now 50-50. They're quite a bit bearish on the small stocks versus a balanced portfolio. And this is growth stocks. This is a balance of growth and value. And then I guess you'd call Russell value. But so there's a dispersion there. Okay. And then you see they're very short CAD, even more short Aussie, very, very, very short yen, which makes sense because they're very, very long the Japanese stock market, and that's the normal correlation. And they're very, 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 very short the Swiss franc, which is new because Swiss franc used to be over here. So what changed? Well, the central bank of Switzerland, okay, created a scenario of a weak Swiss franc. They're already cutting interest rates. Well, now we see the change in the stock. Not stock like a corporation share, but how much of the asset is in the vault. Okay? That's the stock. Now, these change. These things change. So Bitcoin's 50-50. Well, I won't know in a month, let's say, if they're going to buy it back or continue selling. Now, we do track the reportable positions, okay? And then we update once a week, and we can track flow. So right? 80% of institutional investors are long the Japanese stock market. And in fact, okay, we didn't get more buyers of the Japanese stock market, but we lost a lot of bears to a tune of 6% more bullish. There's just less bears. Okay, copper. Okay, 60-40, but money is going into copper. Well, we actually got more buyers and less sellers. This is important because this is a measure of expectations of future inflation. If inflation is high, which by definition means the value of your money is falling, if everything else is stable, then if high inflation is just weak dollar, and weak would be from the government adding to the money supply, well, then you want to convert your money into a real asset like copper. So you can see that real money is flowing to copper. Real money is flowing to silver. Now, they're down right now. So maybe this will get updated on Friday, or it will get updated on Friday. We'll have to take a look. And then you can track like the pound. Oh my gourd. 11,500 more bears in 1 week and 23,000 less bulls. Holy schnicker-schnocker. That's a massive move. Massive. 4,439 less bulls on the Dow and 2,388 more bears for a change of 9.46 more bearish week over week. Oh my God. So how do you use this information? Well, you knew this yesterday. Okay, we updated QuantBox with that detail. right here. Let me make this a little bigger so you can actually see it. Right here is when QuantBox informed you. If you are a member of QuantBox and you upgraded your account to have the email alerts and the text message alerts, you were sent by email the report highlighting that right here. So Monday's your op and Tuesday is your payday. You're welcome. What do you think? Is that worth $100 a month? To have it sent to your phone? Hey, bro, 13% change, 9% change. Maybe. Maybe. And remember, we're only analyzing in those reports institutional investors. So you're only tracking hedge funds. That's all. The flow versus the stock. So the flow was sell the heck out of Dow. Well, good thing you knew it a day and a half early. Well, actually, you had Friday afternoon, all day Saturday, all day Sunday to think about it. You had all day Monday to set up your trades. And by Tuesday, payday. Okay. What do you think? Better than scalping? Oh, but Wayne, 3.5 days early is, I need more of a heads up. Uh-huh. Cool, right? Isn't it epic? Good to know. Let's do some technical analysis. Boo-boo. Boo, 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 boo. Boo, 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 boo. Bum, 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 bum. Boo, da, boo, boo. All right. Jolt's coming out in 6 minutes. It's tradable. You do you. But the Fed interest rate decision's even bigger. Okay. And look at that. TRADARS has gone to has helped us out and basically said, they're not going to raise, they're not going to cut. Nice. Thank you. But what happens? Well, we don't know how the market's going to react. Let me be clear. We don't know how the market's going to react. There's all new variables. Every time news comes out, there's new variables. How the market's positioned, what the market is worried about or not worried about. This idea is how does it change future expectations? Well, this meeting is going to be different from the last 12 Fed meetings because we had different expectations and all that kind of stuff, right? So we don't know the future. But the one thing I can offer you, again, for a lousy $100 a month, is the opportunity to, without a shadow of the doubt, know the past. There's nothing predictive here. But you will know the past. And in this case, we look at previous Fed meetings, and then we look at as expected. Okay? And notice, like, most of these assets don't have a reliable scalp. These events create volatility. That is true. But when it comes out as expected, so no change, on Aussie dollar, there's barely a pattern at all. Not a 2-hour, not a 4-hour, not a 48-hour. There's just one little 12-hour move and only 2/3 chance of success, but to the upside. Well, that's not that great, so I'll probably pass. Unless I get a trade that I already agree with. Euro dollar, there's a 4-hour, but not a 2-hour, and not a 12-hour, but a 48. And then they're in opposite directions. Well, pass, not really interested. Pound, 4-hour up, 48-hour down. All right, that just sounds like volatility to me. Kiwi, 2-hour up, 4-hour up. Okay, so more likely a scalp on this one. So that's a maybe. If I was going to trade it, maybe. But then I filter this further and say, but I'm really a bear on this pair. So do I want to do that? Well, I guess the note cut and press conference would have to lead us to believe it's risk on. Okay? Now your customer says, well, then therefore it's really the press conference. And that's what it looks like because there's very few scalps. Right? A 2-hour before and after incorporates the press conference. And so that's more of a spot trade. So this one says in that scenario, up. But we'd really have to see like the stock market go up and a bunch of other things go up. Like I'd have to see that risk gauge go risk on. I'd want to see that there's correlation amongst asset classes because I want to sell Kiwi dollar. When I woke up this morning, I wanted to sell Kiwi dollar. I wasn't looking at my charts this morning. I dream about these things. When I wake up at 4 something, I pop up and I'm like, I want to sell the Kiwi dollar. And you think I'm joking? No, I'm not joking. But I look at that and I'm like, okay, there's a pattern, but I don't agree with the pattern and I'm the freaking boss. So I might say, skip it, bro. The pattern might exist, but I don't want to add this to my portfolio. USD CAD, almost no pattern on any time frame. USD Swiss franc, almost no pattern on any time frame. USD yen, a little new scalp, but then a position trade to oh my God. So I look at this and here's what I'm thinking. I have a tool that shows me the past. And I have good information. And I can go through the past. And I can see the past. Oh. All right. Looks like some bearishness, right? In the situation, USD yen, if you're trading USD yen, okay, and the results are no change. Okay? Going back years. And I look at the pattern, and 2/3 of the time, in a result of no change, it closes lower. So it dropped, right? Well, you see it went up for half an hour, and then the press conference pulled it down. This one went straight down. This went up for an hour or so, press conference, and then down. Actually, half an hour and then down. So once again, waited for the press conference. This one went up for a while, waited for the press conference and down. This went up for a full hour. The press conference ended and then fell. This one just fell. This one went up again for about an hour. Got in the middle of the press conference, it fell. Okay, this news spiked and went up. People were expecting something different. Oh my God, look at the rally. Then we waited for the press conference and then it fell. So how about this? I could go to this type of conclusion. I may not actually want to trade this at all. But if I did, I could consider, and I'm not saying this is the right decision, I could consider that I could look for bearishness based on past performance. And I have all the permission in the world to wait a half an hour to 45 minutes. And then if I see bearishness, in particular a resistance, I can take a shot to the downside. And it's really mostly a little scalp. So I could do a 25.50 OCO to the downside, but not until after the conference starts. But because I'm risk off, and that might be a risk off scenario. I don't know, because I don't know how the market's going to react. I may not actually want to sell a dollar. But if I was going to, this looks all right. But then you say, well, what about the Bank of Japan and its intervention weakening? So, okay, so maybe this one's less reliable. That's a good thought process. Once again, you're thinking forward. And you're like, well, but these other things may not have taken into account intervention. True. But at least I know if I was going to do this, if they don't change interest rates, then I have a half an hour to 45 minutes to set this up. And even if I see green candles, I'm better off selling at resistance than chasing green candles. Because in all these different aspects, 66% of the time, 67% of the time, it fell even if it got a green candle. So I have, because I'm informed with better data than 99.5% of the market, I have the patience and discipline to wait, and that might give me an edge over my competition. Huh? Smarter than my competition, better looking than my competition, but the best thing about me is my modesty. Now, that's a joke, of course, but here's where the confidence comes from. I have better data. I'm more informed. I'm confident based on my facts. Cool. So Kiwi, USD Swiss franc, probably skip it. USD kitty cat, probably skip it. How about Kiwi dollar? Ugh, I just don't want to sell it. So we can go here and say, all right, show it to me. All right, so this one went up. This one went up. This one went down and then up. This one went down and then up. This one went down and then up. This one went up. And this one went down and up. This one went down and up. Okay, you see the logic here? If you've decided, and even if you just trust the pattern, it's a form of decision. It's a decision-making process. And you can say, you'll either buy this dip, okay, or you'll buy that dip. But you can say, I'm not going to sell it, and if it falls, you just won't sell it. Because 67% of the time in the past, it didn't fall. So at least make the decision and have the discipline to carry out your strategy. No matter what happens, it falls 100 pips, irrelevant, because it's not the strategy. Now, you might pick up the trend tomorrow. That's fine. This is not a trend, what we're doing here. This is a high volatility event-driven strategy based on facts. You have an edge now. So if it falls, you know not to be a bear. And so pre-news, mark all your levels of support that you think would likely hold if Kiwi dollar falls. You understand? Go find your pivot points. Go find your psych levels. Go find your long-term moving averages. Mark them all down and see if you have a cluster or a confluence of these support levels. You're like, oh my God, well, this pivot point is basically the daily 21 or the 4-hour 21. You're like, oh my God, that is so interesting. And it's a role reversal over here. What used to be resistance would be support if we got a bounce here. Yes. So you're looking below where price is now, because you have a strategy based on facts. Cool, right? Now you sound like boss mode. So if it falls, you get all tingly and excited. Ooh, not because you're chasing it down and you know that fails. You know it fails. You've tried it 1,000 times. Chasing price fails. So Instead, you're like, well, if it drops way down here, I'm going to look for a bounce and take a shot. And you have as much as 45 minutes to wait. Maybe it'll be 15 minutes. It'll fall for 15 minutes. Maybe it'll fall for a half an hour. Maybe it'll fall for 45 minutes. Maybe it'll fall for 1 hour. If it keeps falling, you just never get opportunities to buy. That is simple technical analysis. I never said just buy it because it's a red candle. That's dumb. Okay? You identify the support level, and if it falls and then you see reversals on smaller time frames, the risk-reward ratio becomes favorable, plus you have this almost inside knowledge of the patterns of past performance. Doesn't predict it'll do it, but you can be ready, willing, and able to buy low at support if it goes from red candle to green. So imagine somewhere in here, just as the press conference starts, on a 5-minute chart, you see something like this. Do you see the opportunity? Somewhere in here, you go long, and you're long right here. Capiche? This falls, and somewhere in here, the press conference starts. So somewhere in here, price had been falling, so it looks like this on a 5-minute, and then suddenly you get one of these. Cool. So you go long, probably about here. So on and so forth, but not until it's fallen to support and held. Not until it's fallen to support and held. So you have to be able to find the support if you're going to be any good at this. So how about the psychological level of 62? You analyze this and you're like, well, somewhere around 62 looks like it might be support. Boom! Okay? This, not a psych level, but what if it was a pivot? What if it was a role reversal? So what if it was more like, okay, what if it was like this? And you found yourself sitting right here and the news conference starts and you get a little up move. Take a shot. Shot through the heart. You're so lame, darling, you give rock a bad name. All right, so you see, you're not going to get them all. You're not going to get them all, but you're definitely not going to sell no matter what happens. The second thing is, did you get this one? Probably couldn't catch it. You're not going to get them all. But what about this one? Yeah, you got that one, bro. That one you got. Because remember, you can only buy dips. Because you are a bull. It's the only thing bulls do. If you do something different, you're not a bull, you're not a bear, you're a bat. Does anybody know what a bat stands for? If you're not a bull and you're not a bear. So bulls buy dips. Bears sell rips. Okay? What about bats? Type in a question mark if you don't know. This would be my definition of strategy. So, if the Fed does not cut, my strategy would be to only buy dips on this pair. Thank you, Hamid. Yes, a broke-ass trader. If you do something other than buying dips or selling rips, you don't get it. You're not even on the same planet. You would have to very quickly be honest with yourself and say, I don't know jack about trading. You're making it up as you go. You're going to get slaughtered. Okay, who gets slaughtered? Pigs. Okay. So you would have to dude, seriously join Investor Bootcamp, watch 100 hours of training, then upgrade your account for live groups, and we will fix you. Because if you can't carry this out and dude, a 67% chance it's going to go up and you can't trade it properly, it's not TRADARS, it's you. And don't get all pissed off at me. I'm telling you the truth. So then we can fix that if you're honest with yourself. Oh, it's my broker trading against me. Sure it is, bro. It's not you. So, amazing tools though, huh? Amazing tools. Absolutely amazing tools. Okay? And I'm building a presentation. I hope to give it sometime soon. But using TRADARS, I've analyzed 27,804 instances of patterns. And I know which ones work. Let's say, let's do it differently. I know which ones work, let's say, greater than 70% of the time. And some of them are significantly better than that. I know exactly which ones. I broke them down into 5 different categories. 15 different patterns and 5 different categories. And this doesn't include things like Fibonacci patterns that QuantBox also knows, because those are not really patterns, they're momentum plays. You understand that? It's not really a pattern because Fibonacci is just another version of buy the dip. It's just it'll recognize these things and TRADARS reports them, but they're not really patterns. So of the real patterns, like for example, I can tell you, and I don't remember the number, but let's say 1,862 times TRADARS saw a head and shoulders pattern. And I know how many times works because not only does it recognize a pattern, it watches to see what happens after the pattern is coming to fruition. It sees it coming, then it recognizes that it's happened, and then it follows it after the fact, and then reports back to my analysis. And I also know which ones to skip. Very popular, very loved by your last idiot guru. And I know quantitatively that they're unreliable. And I can prove it to you quantitatively. I have the math. And it's so awesome. I can't wait to reveal this to you. And not one iota of opinion. Right? And this is so good quantitatively because I used to do things like this. Up, down, up, uh-oh. Okay? And then I would say, then you create a neckline and you measure this out. And then you take the distance from the top of the crown to the bottom. And you can do a projection here. So, right? So when you get to here, you take the distance from A to B, okay? And then you expect a lower high, lower low. And from this point, you take the distance to A, B, and you predict from C to D, where A to B is equal to C to D. I know that. And your YouTube guru that's been trading for 5 years knows that because he read it in a book. And the guy that wrote the book bought a DVD in 1992. And the guy that made the DVD was taught by his mentor at a bank in 1976. But riddle me this. Does it actually work consistently? And precisely, what is the percentage of times it actually works? Or does it you just feel like it works? Do you just think it works? Guess what? I know the exact percentage. But look, if you only saw 28 head and shoulders patterns and found out that they worked, that's not statistically relevant. You need a minimum of 30 instances as a bare minimum, and then you create bell curves and all that kind of stuff. How often does it work? How often does it not work? Well, again, what if my data set was 1,641 instances of head and shoulders patterns? And I told you, I'll just make up a number. This is just a made up number. 72% of the time it worked. But then I looked at 1,219 inverse head and shoulders and analyzed them. How often did it actually work? Would this be useful information? It's actually mind-blowing, isn't it? So if I was trying to increase your confidence, I would have to do it with logic. Okay? We're persuaded by emotion, but you would have to intellectually believe, wouldn't you? And then you would find rationale. Then you would find the emotion after. But I know statistically and precisely the reliability of these patterns, having measured 27,804 of them. And all of those are recent. So that doesn't go back to in 2007, we looked at some of these patterns. No. Market conditions may have been different there. Volatility may have been different. Volume, liquidity may have been different, and the patterns would have been different. These are all recent. Oh my gourd. Mic drop.